Why U.S. Treasuries could trigger the biggest crash in history. If we liken the global markets of 2025 to the eerie calm before a cataclysmic storm, then the next 60 days could be the blinding flash of lightning that rips the sky apart, unleashing chaos on an unprecedented scale. I am LTC Trinan, a relentless analyst who has spent the last 2 months buried in the trenches of publicly available data from the U.S. Treasury Department. The deeper I dug, the more a chilling dread crept up my spine, like uncovering a ticking time bomb wired to detonate at the heart of the world's financial system. This isn't some doomsday prophecy fueled by speculation or conspiracy theories. No, today we're diving headfirst into cold hard facts, razor-sharp logic, and the undeniable signals of a crisis that could shatter economies, vaporize fortunes, and redefine the fate of billions. Buckle up, because what we're about to unpack isn't just about Wall Street wizards or Beltway bureaucrats. It's about your portfolio, your savings, and the very stability of the world as we know it. Let us kick things off with a brutally simple analogy that cuts through the noise. Imagine you're drowning in $1 million of debt, with the repayment deadline looming like a guillotine. In your bank account, a measly $100,000, barely enough to buy time, let alone settle the score. What do? The options are stark and unforgiving: roll over the debt by borrowing fresh cash at sky-high rates, or declare bankruptcy and watch your world crumble. Now, amplify that nightmare to cosmic proportions. What if the debtor isn't some hapless individual, but the United States government itself, the supposed unbreakable backbone of global finance? This isn't hyperbole, it's the grim reality staring us down from the Treasury's own ledgers. According to the U.S. Treasury's March 2025 report, by June 30, 2025, a date that's already etched in history as a potential inflection point, the U.S. faced a staggering $6.5 trillion in maturing debt obligations. That's not a typo, trillion with a T. Over 80% of this mountain was low-yield paper issued during the pandemic frenzy of 2020 to 2022, when interest rates were practically giveaway levels, 0.1% to 0.5%. Back then, money was cheaper than dirt, and the Fed was printing like there was no tomorrow. But tomorrow has arrived, and it's a brutal wake-up call. The Treasury's coffers, sitting at a paltry $500 billion in cash reserves, enough to cover a fraction of the interest, let alone the principal. It's like showing up to a poker table with pocket change while the high rollers demand billions. Compounding this fiasco is the Fed's iron-fisted grip on benchmark rates, locked in at 4.5% to combat lingering inflation ghosts. New Treasury bonds. They're now fetching yields in the same ballpark, meaning any attempt to refinance this debt avalanche would slap on an extra $290.5 billion in annual interest payments. That's not pocket change, that's the entire GDP of Sweden, a nation of innovation and prosperity, flushed down the drain every single year just to service the beast. Picture it, the U.S. is essentially refinancing its mortgage at predatory rates while the house is already on fire. And let's not sugarcoat it, the flames are spreading fast. The real terror lies in the eroding faith in U.S. Treasuries, once hailed as the ultimate risk-free asset, the gold standard of safety in a volatile world. Over the past decade, central banks worldwide have slashed their holdings from 67% to a precarious 52% of global reserves. Heavyweights like China and Japan, they've been dumping U.S. debt for 24 straight months, offloading billions as if it's toxic waste. Why? Because the myth is unraveling. Treasuries aren't invincible. They're vulnerable to interest rate spikes, inflation surges, and geopolitical tremors. It's like using your credit card to pay off your home loan, short-term relief, but the interest snowball turns into an avalanche that buries you alive. And when creditors start questioning the collateral's value, the lending spigot dries up overnight. You might be thinking, so what if Treasuries tank? How does that hit Main Street? Fair question, but history screams the answer. Flashback to March 2023, Silicon Valley Bank SVB imploded spectacularly, hemorrhaging from $91 billion in U.S. Treasuries and mortgage-backed securities (MBS) that plunged in value as rates soared. It wasn't just SVB, it triggered a domino effect, sparking the largest regional banking crisis since 2008. Fast forward to today, and the iceberg submerged mass is even more menacing. U.S. financial institutions are hoarding over $12 trillion in government bonds, with a whopping 37% leverage to the hilt. Think about the mechanics. A hedge fund starts with $10 million in seed capital, layers on mortgage-backed reinvestments, and suddenly controls $560 million in bonds at 56x leverage. It's a house of cards built on borrowed dreams. When the 10-year Treasury yield rocketed and prices cratered from $140 in 2020 to $95 now, levered investors took a 30% haircut. But those leveraged cowboys, they got wiped out, portfolios evaporating like mist in the desert sun. The fallout: global hedge funds bled over $800 billion in Treasury trades last year alone, and 18 U.S. banks folded under the weight of bond losses. This isn't isolated, it's systemic. The panic has gone viral. Japan's central bank burned through 960 trillion yen in market interventions to stem the bleed, while the European Central Bank dusted off its quantitative easing playbook to backstop the Treasury turmoil. If this debt crisis is a high-stakes poker game, the U.S. is bluffing with a weak hand, but it's playing to masterful cards to stay in the game. First move, devalue the almighty dollar. Second gambit, pump up gold prices to fabricate a safe haven illusion. As the dollar wilts, gold has skyrocketed from $1,800 per ounce to $2,300, a blistering 27.8% surge. Why the correlation? The U.S. vaults hold 8,133 tons of the yellow metal, the world's largest stash, and that's before counting the 10,000 plus tons borrowed or influenced from allies. Every tick higher adds $430 billion to America's official reserves, a windfall that offsets Treasury woes. Global capital flees Treasuries into gold, unwittingly transferring the burden. It's a masterful sleight of hand. One fist devalues the dollar to shrink debt, the other inflates gold to harvest profits. Textbook financial warfare, straight from the annals of economic strategy. With less than 3 months until that fateful June 30, 2025, deadline, now a rearview mirror moment that still echoes, the clock is ticking louder than ever. For everyday folks like you and me, navigating this minefield isn't about panic selling or doomsday bunkers, it's about smart, calculated preparation. Here's a deeper dive into the forecasts and actionable insights, grounded in data and historical precedents. The final week of June emerges as ground zero. If the U.S. fails to roll over those treasuries successfully, perhaps due to a buyer's strike from wary investors, we could witness a technical default, even if short-lived. Markets would convulse. Expect stock indices to crater 5% or more in a single session, echoing the 1987 Black Monday crash but amplified by today's interconnected algorithms. Volatility indexes like the VIX could spike to 50+, turning trading floors into war zones. July might ignite the global asset meltdown. Layer on the U.S. delayed reciprocal tariffs postponed 90 days from April, and you've got a double-barreled shotgun. Debt pressure meets trade wars. Emerging markets, already fragile, could see currencies implode, with ripple effects hitting commodities from oil to soybeans. Remember 2018's trade skirmishes? Multiply that by 10, as debt dynamics supercharge the fallout. Cash and true safe havens are your lifelines. History is our guide. In the 2008 Great Recession, gold soared 25% while the USD strengthened 15% amid flight to quality. During the 2020 pandemic plunge, gold jumped 12% and the dollar 8%. But don't bet on one horse. Diversify into a mix of hard currencies, physical assets, and yes, even select cryptocurrencies, whose market cap has breached $1 trillion, challenging fiat dominance for the first time. Avoid over-leveraged stocks or bonds. Instead, build liquidity buffers to weather the storm. Zoom out. And this isn't just another cycle, it's a paradigm shift. U.S. debt has ballooned to $36 trillion, triple the 2008 levels, while the dollar's share in global reserves dips to 58%, the lowest since 1999. Every 10 to 15 years, from the 1929 crash to the dot-com bust, the world undergoes a wealth redistribution. This time, with crypto's rise and central bank digital currencies on the horizon, we're not just reallocating assets, we're rewriting the monetary rulebook. BRICS nations are accelerating de-dollarization, stockpiling gold and exploring alternatives like yuan-denominated trades. We can't halt the hurricane, but we can anchor ourselves in its eye. Shun speculation, embrace knowledge of the cycles and steadfast common sense. The financial world thrives on illusions and manipulations, but truth lurks in the data. The $6.5 trillion debt bomb isn't an endpoint, it's the catalyst for a new era. In the next 60 days, stay vigilant, arm yourself with reason against fear, and position for the rebirth. Crises aren't mere destruction, they're the demolition of outdated orders, birthing fresh opportunities for those bold enough to seize them. The storm is coming. Will you be swept away, or emerge stronger on the other side?